Okay, so now you understand the importance of position sizing to ensure that every single trade you take, you risk the same percentage of your capital. And by ensuring that your average win is double your average loss, if you do that consistently, you will always make money over time. So how do we automate that in our trading process? That's what I'm going to show you right now. See, many people are surprised to know that when I trade the US markets exclusively, when I swing trade, I don't look at the markets when it's open. In fact, all the research that I do, finding trades and placing orders, happens before the market opens. The moment the market opens, all my trades are executed automatically. I don't even have to be there. So before the market opens, I close my computer, I go do something else. I distract myself with my family, with my friends, whatever it is, right? In fact, watching the market when it's open is counterproductive. Because when you watch the day-to-day fluctuations of the market, the more you watch it, you can't make the price go up. You can't make the price go down. In fact, what it does is that it affects you emotionally, right? When it goes up in your favor, you feel good. When it goes down, you feel bad, right? And when you get affected emotionally, you may tend to intervene in your trades by changing your orders. For example, if it's going down, you think, you know what, it's going to hit my stop loss. I don't want to get stopped out. Let me lower my stop loss to give me some more space or some more buffer, right? Or sometimes the price may go up and you say, hey, you know what, I think it's going to go a lot higher than my target profit. Let me remove my target profit. And I can guarantee you that by screwing around, by changing your target price and your stop loss, you will no longer have a positive expectancy in your trading system. So in the short run, by intervening, it may make you a bit more money, but in the long run, it's going to cause you to lose money because you no longer have a positive expectancy, a statistical edge in the market. All right, so I'm going to teach you right now how do you automate your trading such that you don't have to spend more than an hour a day to find trade setups, to place your orders. So when the market is open, the buying and selling is done automatically for you. You just have to watch the market, or rather, you just have to look at the market the next day when it's closed and make the next decision. All right, great. So let's begin. Okay, so the first kind of order that can be placed is known as a market order. A market order is an order to buy or sell at the current market price. So for example, if the market price is $10, for example, it's the current market price, right? And you place an order to buy at the market, what happens? It will buy at $10. Right? Simple as that, right? If you put an order to sell at the market price, it would sell at $10. Now understand that when you place a market order, the price that you see on the screen is not guaranteed. Why? Because when the market is open, the price moves continuously. Every second it's changing. In fact, every microsecond is changing. So for example, if you look at the price is $10 right now, and you place an order to buy the market, by the time your order reaches the stock exchange, the price may have changed to $10.01 or $10.20, for example, right? So the price you get is not guaranteed, but your order is guaranteed to be filled because you are definitely going to get what you wanted to buy or sell. So that's a market order. Now, I mentioned earlier that I place my orders before the market opens, not when the market is open. So as a result, I never use market orders. All right? So let's go on to the next kind of order known as a limit order. A limit order is an order to buy or sell at a specific price or better. Okay? And when you use a limit order, the price is guaranteed because you specify the price you want. But your order is not guaranteed to be filled. So let me give you an example. So let's imagine that currently the price is kind of like moving up. Okay? It's the stock price. And it's currently at $10, for example. And you want to place a buy limit order. So you place a buy limit order at, say, $9.80. This is a buy limit order. So what does this mean? If you place this order with the broker, it means that you only want to buy the stock at $9.80 or lower. Okay, so whenever you put a buy limit order, it will only buy at that specific price, which is $9.80 in this case, or lower. All right. So in other words, would you end up buying the stock? Well, you only end up buying a stock if the price goes from $10 down to $9.80. Then you'll get it at $9.80. Now, if the price goes from $10 and suddenly it gaps down to $8, for example, would you buy it? Yeah, you buy it at $8 because a limit price means you buy at the price that you want or lower for a buy. Because when you buy, you always want to get the cheapest price, right? So, or lower is better. You know what I'm saying? Okay. Now, what's a sell limit order? Okay. So again, if the price is at $10 and I put a sell limit order at say $12, limit, what does it mean? Excuse my handwriting, right? Okay. So a sell limit order at $12 means that I only want to sell at $12 or higher. Because in selling, higher is better, right? Okay, so is it a guarantee I'll sell it? No. If it doesn't go to $12, I never end up selling it, right? But if it goes to $12, boom, the order is triggered and I buy at $12, okay? Now what if the price suddenly gaps up from $10, it gaps up to $13? Do I get to buy it? Yes, because I buy it at $12 or higher, right? So that's how limit orders work. Now, people who are long-term investors, they use limit orders to enter a new position, to buy a stock, right? Because long-term investors, they want to buy as cheap as possible. So for example, if it's now at $10 and you're a long-term investor like Warren Buffett and you say, you know what, I can wait, I'm patient, right? And you may say, hey, you know what, I want to bargain. I don't want to pay $10. I only want to pay $9.80. So only if it goes to $9.80 will you buy the stock. So you don't mind buying at a lower price. Now, as a short-term swing trader, we never use limit orders to buy. We never use limit orders to buy, to enter a position. Why? Because as a trader, we never want to buy when the price is going down, right? We are catching the momentum of the price going up. So we only want to buy if the price is going up from $10, not going down. So we never use limit orders to buy as a trader. Okay? However, as a trader, we will use limit orders to take our profits. So in other words, if we enter the stock at say $10 or higher, we place a order to take a profit at $12. We put a sell limit order. Once it hits $12 or higher, boom, we're out with our profits. Okay? So that's how limit orders work. And in a while, I'll show you exactly when we use limit orders and when we don't use limit orders. So hang on for that. Okay, so we've looked at market orders, we've looked at limit orders. The third kind of orders that we can use are what is known as stop orders. What's a stop order? A stop order is an order to buy or sell at the market price only when a particular price is hit. And that price is known as the stop price. So for example, if the market price is currently at $10, okay, this is known as the market price, okay, and I place an order to sell at a stop price of $9. Okay, so this is a sell stop order. Okay, so it's a stop order, it's a sell stop order at $9. Now, what does this mean? If you place this order, it means that if the price goes to $9, right? Recall that $9 is the stop price. The moment it goes to $9, it would stop and sell immediately at the market price. Okay? So when do we use this? This is usually this is usually used to cut our losses when we are in a losing trade. So in other words, right now we're in the trades at $10, and if it goes up, we keep making money. If it goes down, for example, we are losing money. So if it goes down to a certain price, we want to cut our losses and run. Okay, so we use a sell stop order. In this case, it'd be $9. Okay, so the moment it hits $9, boom, the broker would get me out at the market price. Now again, remember that because it's a market price, it's no guarantee that I'm going to get it at $9. Okay, but I'll get it somewhere there. Like for example, the moment it hits $9, by the time it's executed, it may go to $8.99. All right, but most of the time you get it at about $9. Okay. Now, what's a buy stop order? If I use a buy stop order, if I put a buy stop order at say $11, what does it mean? Okay, and currently the market price is $10 as well, right? So if I put a buy stop order at $11, what it means is that if the price goes to $11, what happens? That's right, stop. The broker will sell it for me at the market price. Okay, so when do I use this order? Again, I use it usually to cut my loss. Okay, if I'm short, if I've got a short position. So let's imagine I have got a short position in the market and the price is at $10. So a short position means that if it goes down, I'm making money, right? If it goes up, I'm losing money if I'm shorting the stock, right? So the moment it goes up to a certain price, say $11, hey, I want to cut my losses, boom, I'm out. So we use buy stop orders to cut losses for short positions and sell stop orders to cut losses for long positions, right? And that's how we use stop orders. Okay, now let's take a look at a stop limit order, which is kind of like a combination between a stop order and a limit order. Now, we use stop limit orders to enter a trade, to enter a long trade or to enter a short trade. So what's a stop limit order? It's an order to buy or sell at a limit price, or better, only when a particular price is hit. Again, that price is known as a stop price. Okay, so a buy stop limit buys at a limit price or lower when a stop price is hit, as opposed to just the market price. So let me give you an example of how we use it. So for example, I want to enter a trade, a long trade, and I see that the stock is showing a pattern where it's going up, coming down, going up, coming down, and it hits a support level over here. Say there's a support here, like a moving average. And I anticipate that the price will continue up. So I like to buy somewhere over here. Okay? Now, at this point, let's imagine that the price of the stock is at $50. Okay? And this was the previous day's closing price. Now, do I want to buy it at $50? No. As a swing trader, I always want to buy higher than the last day's closing price. Why? Because I only want to enter the trade if I am sure that the price is moving in the direction which I want. That means I'm catching the momentum of it as it's going up. Make sense? Okay. So in other words, if the closing price is $50, I want to buy slightly higher than that. That's my entry price. So for example, my entry price could be $51, for example. That's my entry price, right? So I'll put a buy stop limit order. In this case, the stop price would be my entry price, which would be $51, for example. Okay. Now, if I purely just place a buy stop order, the moment it hits 51 the next day, it would trigger and buy at the market price. Okay. Now, there's a bit of a risk in that if the price suddenly gaps up from 50 to say $55 the next day, I would end up buying it at $55 because If you just use a stop order, it buys at whatever is the market price. So the risk is I could buy too high a price. So I want to set a limit to say, fine, if it hits $51, enter it at a market price, but no more than a certain price. So I could put a limit of about, say, 10 cents above the entry price to give a 10-cent buffer. Okay, so when I place this order, it means that the next day, if it goes to $51, confirming the direction which I want, it would trigger the order and buy at the market price, but no more than $51.10. Okay, so that's how I use a buy stop limit order. Next, I would use a sell stop limit order to enter a short trade. Okay, so now in this case, I see the price is on a downtrend. Right, it's got impulse, correction, and again it hits a kind of a resistance over here, and I expect it to continue going down. What do I want to do? I want to do a short sell. I want to enter short. So let's imagine at this point of time, again the price is $50. Right? Now, do I want to sell it exactly at $50? No, because if I sell it at 50, it may continue going up. I only want to sell it if it has confirmed that it is going down. So I want to put an entry price somewhere below the last day's closing price. So I may want to put it at $49, for example, to enter at 49. So I'll put a sell stop limit order, where again my stop price would be my entry price. So in this case, my stop price would be 49, for example. So I'm telling the broker, okay, the next day, if it goes to 49 like I expected, stop, sell it for me at the market price, but no lower than a certain price. So I'm going to give myself a buffer. Again, I could put the limit price 10 cents below that stop price. So 10 cents below that stop price would be 48.90. So don't sell anything less than 48.90, because if the stock suddenly gaps down, I don't want to end up selling at a market price of 45, for example. All right? So that's how I use a stop limit order. The other thing is when you place an order with the broker, you have to specify if it's a day order or if it is a good till cancel order, GTC order. A day order is an order that is enforced during one trading day. So for example, you place an order to buy or sell. If it's not executed within that day, you'll be cancelled automatically. That's called a day order. A good till cancel order is an order that you place that will remain in force forever until you cancel it or it is executed. Okay? Now, usually when I place orders, I always place good till cancel orders, GTC orders. And the next day I'll check it. If it's not triggered and it's still valid, I'll leave it till it is triggered. If it's no longer valid, I'll cancel the order. Okay? But you may place a day order if you want as well. There's nothing wrong with that. All right? So by the end of the next trading day, if it's not triggered, you'll be cancelled automatically. But whenever you place an entry order, for example, you're entering a long trade, right? And it's going up, you're making money. If it's going down, you're losing money, right? Now, whenever you enter a trade, you have to simultaneously place a stop loss order and a take profit order. And I'll teach you again which orders to use for your stop loss and for your taking of profits. Now, we call this a bracket order because it's kind of like a bracket. It either hits your take profit or your stop loss, right? Now, these two orders must be good till cancel, GTC, because we always want them there until they are hit. Okay? And the beauty about these systems is that it is linked together, which means the moment the target price is hit, both the stop loss order will be cancelled automatically. If the stop loss order is hit, the take profit order is cancelled automatically. So it's a one cancel one order, or OCO order. And both these orders are only activated if the entry price is activated. All right? So we always use good till cancel orders for the take profit and the stop loss. Yeah? And for your entry price, it can be a day order or GTC order. Okay, so with that, I'm going to teach you now how to structure your trades using these orders. So when we place orders using the trading systems, or to execute the trading systems, we always use what is known as bracket orders. What's a bracket order? A bracket order consists of 3 orders being entered at the same time. Okay, 3 orders. So it includes your entry price, your stop loss price, and your target price. And the reason why we call it a bracket order is because they are entered together, that's one thing, and it's also known as an OCO order, or one cancels one order. Why? See, only when, let me give you an example over here, right? So, for example, this is a bracket order where we will enter our entry order here. This is known as our entry order. I'll explain what that means more. So this is our entry order. So let's imagine we are going long. We think the price is going to go up. We're going to go long. We're going to place an entry order. And at the same time, we're going to place a take profit order, our TP, as is known, and our stop loss order, or known as the SL order. Great. So all 3 orders are placed at the same time. Now, these orders are known as conditional orders. Why? Because only when your trade is executed and you enter the long trade will the target price order and the stop loss order be pending, will be activated. In other words, if you don't buy the stock, if your buy order is not activated, your TP and SL is not activated as well. Okay? Now, once all the orders are activated, what happens is, if the price goes down and hits your stop loss, you will exit the trade with a loss, and automatically your TP, your take profit order, will be cancelled. If the price goes up and hits your take profit order, you will exit with a 2R win, and automatically your stop loss order will be cancelled. So that's why we call it one cancels one order. Okay, so these are how we place these orders. Now, first of all, I'm going to show you how we place a long trade order. So what happens is, when we're going long, we always place a buy stop limit order. All right, a buy stop limit order. And my suggestion is to put it as a good till cancel order. So what happens is that you place the order, and if it's not executed when the market opens, the next day you can cancel it manually yourself. All right. So for example, if you place a buy stop order of $50, what does it mean? It means that if the price goes to $50, it will be stopped and it will be bought at the market price. Okay, but we want to ensure that we don't buy at too high a price, so we have to place a limit to how high we're willing to buy that stock for. So hence there's also a limit order. Now bear in mind, this is one order that has got a stop and limit price. So usually the limit price is 3 to 5 cents higher than the stop price to give a buffer. Okay. Now, together with the entry price, we will place a stop loss price. And the stop loss price will be a sell stop order, which has to be a good to cancel order. So it's got to be there all the way till it is cancelled by the system, or it is activated, it's executed. So in this example, we want to buy this stock at $50. So we place a buy stop limit order of 50 stop, 50.05 limit. And we place a sell stop order at $48 in this particular case. All right. So what does this mean? This means that our risk per share is $2. Because after buying it at $50, for example, if the price goes down and hits our stop loss, we lose $2 for every share that we buy. Hence, that is known as our risk per share, which you've learned in position sizing. Okay? So if our risk per share is $2, where must our profit target be? It's got to be double our risk. It's got to be $4, right? It's got to be 2R. So we place our target price, once again, $4 above the entry price in this case, which will be at $54. And our target price or target price order is known as a sell limit order. And it must be a good till cancel order. So why is it a sell limit order? A limit order means we only want to sell at $55, we only want to sell at $54 or higher, but no less than $54. That's our limit. That's why it's known as a limit order. Okay? But for your stop loss, notice it is known as a sell stop order. Why? Because the moment it hits $48, we say, stop, I'm out. Get me out at whatever market price. Okay? So notice that your stop loss order doesn't guarantee that you get out at $48. You may get out at 47.9 or 47.99, right? But it ensures that the moment it hits 48, we will get out of the market immediately, all right? But for sell limit order, we are guaranteed that we will get $54 at the very least, okay? That's why it's known as a limit order. So if you use any broker, any decent broker will allow you to place these bracket orders. So I'm going to show you an example of, this is the interactive brokers, or if you're using Halifax, this is what their mobile app looks like. And I use their mobile app because it's really easy to enter orders. So here's how I do it, right? So what I do is I enter, first of all, the stock that I'm going to buy. So in this case, the stock is SHLD. Now bear in mind that when you key in the stock's name, SHLD for example, or Apple for example, there'll be a menu. And in the menu, they'll ask you, do you want to buy the stock? Do you want to buy the options or the CFD or the futures, all right? So usually you would choose the stock, right? Buying the stock itself, or if it's available in your country, you could buy the CFD. And I'll talk more about CFDs in a short while, okay? So whether you choose stock or CFD, there'll be a whole list of entries below that you have to key in, all right? So the first thing to key in is the quantity. How many shares do you want to buy of this stock or of the CFD? So this quantity is based on the position sizing you've just done using the calculator, which you've just gone through. So in this case, for example, we want to buy 800 shares of SHLD, right? So there you go, 800 shares. Next, you have to put in the time in force. So is it going to be a day order or a good till cancel order? Now in this case, I've chosen day order, which means that this order only lasts for a day. By the end of the day, if the price doesn't reach my intended entry price, it will not get executed, it will be cancelled by the end of the day. So you could use a day order if you want to, but usually my preference is to use a GTC order. So you could select GTC instead. And again, GTC stands for good till cancel. So if you choose a GTC and the trade is not executed by the end of the day, you have to manually cancel it the next day, right? So it's up to you, right? Next, you have to select the order type. So for the order type, you have to select stop limit, all right? Stop limit, where you have to enter both the stop price and the limit price over here. So in this case, SHLD, I'm intending to enter it at 903. That is my entry price, which is my stop price. All right, so let me just note that down. This is your entry price, the price which you intend to enter the trade. So what I'm telling the broker is that, hey, tonight or when the market opens, for example, if the price goes to 903, get in. I'm in. I want to buy the stock at whatever is the market price. But I have to place a limit to say, hey, I'm not willing to buy it if it goes too high. Okay? So usually for my limit, I'll place the limit price 3 to 5 cents above the stock price. So in this case, it's a cheap stock. It's like a $9 stock. So instead of using 5 cents, I use 3 cents. Hence, my limit price is 906. This assures that I will not buy above 906. That's the limit I'm willing to pay. Okay, great. So this entire thing that you see here, this entire thing is known as your entry order. Okay? So once you have keyed in your entry order, you will then attach a bracket to it, right? So it says here attach bracket. So you have to select attach bracket. So once you attach a bracket, you have to then key in your profit taker price or your take profit TP price, okay, which is a sell limit order, and attach your stop loss price, which is a sell stop order. And notice that by default, both of them are good till cancel orders. Okay. So again, where is your stop loss placed? Well, depending on the strategy, you will learn where to place the stop loss. So in this case, we place it at 828. And we place the target price, that's right, 2 hours above our entry price. In this case, it's 1053. So once you key in all those orders, you're good to go. You can click submit buy and your order will be pending in the broker system. And you can do whatever you want, right? So the moment the market opens, okay, only if the price goes up and reaches 903 will it be activated. And you'll buy at the market price and no higher. Okay, so I'm going to show you right now how I actually place an order with one of the brokers. Right? In this case, I'm using Interactive Brokers. If you use Halifax, the same platform, and I'm using the mobile app. Right? Okay, great. So the first thing I do is I'm going to key in the stock symbol, which I'm going to trade. So say, for example, I want to buy Apple. And currently the market is closed, which is great because I always enter my orders before the market opens, never when the market's open. So for Apple, the symbol is AAPL. So I enter that symbol over there, and I'm going to click enter. And I've got a choice whether I want to buy the stock, the futures, the options, the warrants, or the CFDs. Now, like I mentioned, I always use the CFDs if they are available. Because by trading the CFDs, I only have to use 10% of the position size as collateral. In other words, if I buy $10,000 worth of Apple shares, I only need to use $1,000 from my capital. If the CFDs are not available, I'll just buy the stock outright. Okay, so I usually choose CFDs, but I'll just choose stock for now in case the CFDs are not available. So I'm going to click on stock over here. Okay, so you can see that currently Apple closed at 117 the day before. All right, so I'm going to put a buy order. So I'm going to click buy over here. It's a buy order over here. And there are a few things I've got to key in. So the first thing is the quantity. How many shares do I buy? And this all depends on your risk per trade, on your capital, and so on and so forth, right? So using the position sizing calculator, you've got to calculate how many shares you need to buy, all right? So for example, let's imagine I'm going to buy 60 shares. I'm going to key in 60 over there. Great. Now time in force, that's where I select either day or good till cancel. So usually I'll just put it good till cancel. Okay. What is the order type? Remember, when I enter, I always use a buy stop limit order to enter. Okay, this is my entry order. There you go. Okay. So Apple is 117, so I want to enter it higher than where it was yesterday. So if it goes in my favor, I want to get in. All right. So you learn exactly where to place your entry orders depending on the strategy which we use. But for this example, let's imagine we want to enter it at, say, 117.5. All right. So I'm going to place my entry price at 117.5. Okay. And I'll put my limit price 20 cents above the entry price to give a bit of buffer. So it could be 20 cents over there, right? So that's 117 point, sorry, it should be 70 cents. Because 20 cents more than 50 cents is 70 cents. My bad, my bad. All right, great. So we got that there? Great. So that's our entry price. Now we want to attach our bracket order. We want to attach the stop loss and the target price. So we're going to attach an order. Over here, I'm going to click. It says, for some reason, this thing is blocking me. All right, it says bracket over here. I know it's being blocked by this irritating thing. I don't know how. Oh, okay, there you go. It got rid of it. Okay, great. So you see bracket over there? Okay, so you click on bracket over here. Okay. Okay. So you put your stop loss price and your take profit price. So I'm entering at 117.5. Let's imagine my stop loss is, for example, $5 away. For example, right? So my stop loss would be $5 away. What would that be? That would be 117.5 minus $5. So that's 112.5. Okay. Okay. So I'm taking $5 risk per share. So my target price has to be at least double that. So it'll be at least $10, $10 to make at least $10, right? So $10 above my entry price would be 127.5. So my profit target would be 127.5. So double check that. I'm entering at 117.5. I've got a stop loss at 112.5 and a take profit at 127.5. Okay, so once it's good to go, you just submit your buy, boom, and you transmit your order is in. At night, when the market opens, or whatever time zone you're in, okay, if it happens to get to that price of 117.5, it will buy the stock for you. All right, so that's how you place a long trade. Now, how do you place a short trade? So let's imagine now I want to short sell Twitter. Okay, Twitter's going down, I'm going to do a short sell. So what do? Same thing. I'm going to type in the symbol for Twitter. With there. And again, I'll choose CFDs if there was available. So I'm just going to choose CFDs just to show you, but it's the same thing. So Twitter closed at 1782 last night. And I'm going to do a short sell. I'm going to click sell. Once again, I'm going to enter the number of shares to short sell. I'm going to use the position sizing calculator to calculate it. So for example, let's imagine I'm going to short sell 570 shares, for example. Time in force, good till cancel again. Order type, stop limit. Okay, so I got to place my entry price. So the entry price has to be lower than the previous day's close. So for example, I may want to short sell it at 17.60, for example. $17.60. Okay, and the limit price, I may want to put it slightly below the entry price. So in this case, maybe I put it 5 cents below. All right, since it's a $17 stock. Okay, so 5 cents would be $17.55. Cool. All right, great. Next, I will attach my bracket order. Okay, as you can see, bracket over there, bracket. And I'll place my stop loss order. So I am entering at 1760. I may want to place a stop loss, say $1 above that, so 1860. Oh, it's already at 1860, interestingly enough, right? So my take profit has got to be $2 below, which will be 1760 minus $2, that's 1560. There you go. My bracket order is complete. I've got my entry price, my stop loss, and my take profit order. Okay? And once I'm good to go, I just submit over here, transmit my order, and the order's in. And that's exactly how you place orders with your broker. Your broker may have a different software to enter, but more or less it's the same. All right, you can figure it out yourself. All right, now let's talk about contract for differences, or CFDs, a very powerful derivative tool that you can use to leverage and to create more positions for your trading. So first of all, what are CFDs? Let me define them. CFDs are an agreement. See, when you buy a CFD, you're not really buying the stock. You're buying a contract. You're buying an agreement, right? And it's an agreement between you and the broker to exchange at the close of the contract the difference between the opening price and the closing price of the underlying asset, which is the stock, for example. So basically a CFD is a tradable instrument, kind of like options or warrants, if you understand that mirror the movements of the asset underlying it. And the asset could be a stock, it could be a commodity, for example, right? It allows for profits and losses to be realized when the underlying asset moves in relation to the position taking. But the actual underlying asset is never owned. So what does this really mean? So essentially it's a contract between you, the client, and the broker. So for example, let me draw it up for you, right? Let's take a look at Apple, for example. Now, if you want to buy Apple, again, you could buy the underlying shares itself, right? You choose buy Apple. If you key in the ticker symbol in your broker's platform, you choose a stock, you just buy the stock. Simple as that, right? Like I said, if your broker offers CFDs, you have the option to say, hey, I want to buy the Apple CFD. So you're not really buying Apple, you're buying a contract on Apple, okay? So what happens is that, for example, Apple is trading at $100 right now, for example, right? So what happened is that the broker would create an Apple CFD that will mirror the price of the actual stock. So the CFD will be priced at $100 as well. All right, it's basically a mirror of the stock price. So say you buy the CFD. So you go long, you say, okay, I'm going to buy the CFD. Now, a couple of days later, Apple goes to $110. Okay, so what happens to the CFD price? Well, again, the CFD price mirrors the stock price, so the CFD price will go to 110. And you decide, hey, I want to sell it. I want to close my contract, right? So you sell. So what's the difference between the opening and the closing price? The difference is $10. So in other words, that's why they call it contract for difference, because the difference is $10. So what happens now is that the broker will pay you the $10. All right, that's it. Simple as that. All right. Now, if Apple goes down to $90 instead, what happens? The Apple CFD will be priced at $90 as well. So this time, what is the difference? The difference is minus $10, right? So now you owe the broker $10, okay? So essentially, when you're buying a CFD, you are kind of like betting with the broker where the price is going. If you're right, the broker pays you. If you're wrong, you pay the broker, right? So let me say, so what's the advantage of buying the CFD compared to the actual shares? Well, here are a few advantages of using CFDs. The first advantage is that CFDs provide very high leverage. What does that mean? Again, usually when you buy the shares of Apple, for example, if Apple is priced at $100, for example, and you buy, say, 100 shares, okay, what is the value of the shares that you have bought? The answer is 10 $10,000. Correct? Okay. So if you buy the shares itself, you have to actually have 10 grand. Or 10,000 of cash is used from your account to buy the shares. Okay? Now, what happens is that if you use the CFDs instead, you don't actually have to use up $10,000. With CFDs, you just have to use 10% of the position size as margin. So what's 10% of 10,000? Well, 10% of 10,000 is $100. Wrong, $1,000. Excuse me. Okay, $1,000. So this $1,000 is known as margin, right? So in other words, now let's imagine you've got 100 grand in your account. Okay, so if you bought the shares, of the 100 grand, you have to use 10 grand to buy the shares. So you only have 90 grand left in cash to buy other shares. But by buying a CFD, you only need to place a deposit or a margin of $1,000 in order to buy the shares. So you now have $99,000 of cash to buy more shares. Make sense? So that's what is known as leverage. Okay, but of course, why is the broker so kind to allow you to do that? Because they charge financing. There are financing charges. And the financing charges are approximately about 3 to 4% interest per year. And it's charged on a daily basis, which means if you take 3 to 4%, divide by 365 days, you get roughly a pretty small percentage interest per day, which is deducted daily from your account. So what's the advantage of doing this? The advantage is that by doing this, I can create more positions, because if I buy the shares itself, it uses up a lot of cash. Usually, once you have 4 to 5 positions, you can't open anymore. And remember, for each position you open, you're risking 1 to 2% of your cash, of your capital. So if you have got 5 positions, you're risking 5%. That's it. You can't risk more than that. Okay. But with CFDs, I could open 10 positions, for example. And you may say, isn't that risky? Well, if I'm risking 1% per position, even with 10 positions, I'm only risking a total of 10%. So that's still within my realm of risk management. The next advantage of CFDs is with CFDs, you're able to go short without borrowing the shares. You see, if you actually want to short sell the shares of a company, you have to physically borrow the shares from the broker to sell it. Now, to do that, the shares must be available to be borrowed and sold. But there are some shares where the broker says, hey dude, I don't have the shares to lend you, and you can't short sell it, right? But the great thing about CFDs is with CFDs, you don't actually sell the shares. You're making a bet with the broker that's going down. So you're not really selling the shares. So because of that, you don't have to borrow it. So in other words, you can easily take a short position without the worry of borrowing the shares from the broker. All right, so that's another advantage. So let me give you an example right now about how trading with CFDs would allow you to open up more positions than just buying the shares itself. Okay, so let's take a look at the first example where we are buying the shares itself, the stocks, okay? Now let's assume that you have got a capital of $10,000. You open an account, you place 10 grand inside, that is your net liquidation, okay? So you want to buy the first share, the first stock. So let's imagine the first stock is called stock A, right? So you take a position A, and remember that you have to calculate the number of shares to buy, right? So after you do your calculation, you find that you have to buy $2,500 worth of shares to take that first position, right? And your risk is 1% of your net liquidation, which is your original capital. So for the first position, you're risking 1%, which is about $100, right? But you have to buy $2,500 worth of shares in order to take that position. Okay? Now you decide to take another position. How much do you risk? Again, you risk 1% of your capital. The risk is always the same. Remember that. Your risk percentage is always the same. So you buy a second position, same risk 1%, but for example, again, you have to take up $2,500 in cash to hold the second position. And then you take a third position, a fourth position. So what you notice, you have got 4 positions in the market. And each one you're risking 1%, 1%, 1%. So your cumulative risk is 4%, which is in essence $400. So the worst that can happen is if all 4 trades lose, you lose $400 out of 10 grand. Make sense? Okay. But in terms of the position that you're taking, the cash required, right? If each position requires $2,500, for example, by taking 4 positions, hey, you've got no more cash. You can't buy any more shares of any other companies, right? Now that's fine if you want it to be, but some of you may say, hey, I want to take on more positions. So to do that, you have to use CFDs, for example. So in this case, like I mentioned, without CFDs, you take a maximum of 4 to 5 positions. Your total risk is 4 to 5%, and the total return is 8%, of course, if you get double your profit versus your risk. Okay. Now, in the second scenario, I have 10 grand in my account as well. Okay, net liquidation. This time I'm buying the CFDs. So I take on my first position, and I'm risking 1% of, again, that same net liquidation. So my risk is $100. So notice that whether I use CFDs or I use stocks, my risk is the same. No more risk. It's both $100. But this time, instead of using up $2,500 in cash, I only require a margin of 10%, which is approximately about $250 of cash being used from my 10 grand account. Okay? And say I take on a second position, a third position, a fourth position, a fifth position, a sixth position, for example, 7, 8, 9, 10. Okay, so imagine if I were to take 10 positions at the same time. Okay, what's my total risk? 10%. If all of them win, of course, I get 20% return on capital, right? If all of them lose, I lose 10%. But again, notice because each time I'm only using up $250, even with 10 positions, I'm only using up $2,500 from my 10 grand account. So I still have a lot of cash to add more positions, which I should not, right? Because like I told you, the maximum risk you should expose your portfolio to is 10%. That's it. Don't go more than that, right? So of course, theoretically, you could take up to 40 positions, but please don't do that, right? Now notice that although I have 10 positions that are in the market, I may not have 10% risk. Why? Because recall that the moment you enter a trade, if the price moves 1 hour in your favor, what can you do? You can move your stop loss to the entry price. So now what happens is the worst that can happen is the price goes down and hits your stop loss, you break even. So it's a risk-free trade. So in other words, you could have 10 positions open, but they're all risk-free. Okay, so that's the beauty of this system. Okay, there are 2 kinds of CFD brokers that you could choose from, right? First would be DMA brokers, or direct market access CFD brokers. So what this means is that for these brokers, the CFD price would mirror the exact price and liquidity of the underlying stock or instrument as reflected in the stock exchange, right? So this is the one which I prefer to use. And the broker I use, Interactive Brokers and Halifax, they are DMA access CFD brokers. So the benefit is that there's little or no additional spread. Straight through processing, complete transparency. The CFD price is the same as the stock price. Now, the disadvantage is some DMA brokers may offer slightly higher brokerage fees as per normal. But the good thing about the broker I use is that the fees are basically the same as buying the shares itself. Another kind of broker is known as a market maker CFD broker. Now, the difference is that market maker CFD brokers, they make their own price, and they are the counterparty to your trade. And their prices do not always replicate the underlying market majority of the majority of the time. So what it means is that market maker CFD brokers, they may price the CFDs differently from the actual share price. So if Apple is priced at $100, they may price a CFD at $100.20, for example, right? So they earn on the difference. Okay, so you may not always get the CFD price reflecting the true stock market price because they earn the difference. All right, so benefits of using these brokers would be usually lower margins are required and lower brokerage fees, but larger spreads and possibility of price discrepancy with the actual stock asset. So it's up to you, but I prefer the former one. Finally, I have to tell you about the risks of CFDs. Okay, in anything, there are certain risks in trading derivatives, whether options or warrants or CFDs. The main risks of CFDs are that CFDs are over-the-counter derivatives. So they are not actually listed on the stock exchange. And your transaction is with the broker. Okay? And the positions that you open can only be closed by the broker you use. And you have no rights to the underlying asset. So I have to say that CFDs should not be used if you are an investor. You intend to invest for the medium to long term, don't use CFDs because they've got interest charges and you don't actually own the shares. But if you are a trader, you're just going in and out to make a quick profit all the time, then CFDs may be useful for that purpose. Okay. Next, the broker acts as the market maker in the case of the market maker CFD brokers. So your profit and loss is subjected to the CFD price quoted by the broker. In the case of the market maker CFD brokers, may not be the exact price of the underlying shares. Okay. Thirdly, you may lose more than your deposit. Why? Because remember that if you don't use CFDs responsibly, some people, they put in $10,000 into their account. And what do? They buy $100,000 worth of shares. Why? Because remember that with CFDs, you only need 10% deposit to buy the shares, right? So some people, they put in 10 grand and they think, hey, with 10 grand, I can buy 100 grand of shares, right? And they think, my God, if I buy 100 grand of shares and it goes up by 10%, 10% of 100 grand is 10 grand. I double my money overnight. But what they fail to realize that if you buy $100,000 worth of shares and it drops by 10%, what happens? Your entire capital is wiped out. Or what if you bought $100,000 worth of shares and it dropped by 20%? You just lost 20 grand, but you only put in 10 grand, which means not only did you lose your capital you put in, you now owe the broker an additional 10 grand. So if you do not follow the very strict measures of position sizing and risk management, do not ever use leverage products like CFDs or options because you could lose everything that you have overnight and more. But if you follow the strict position sizing rules where you only risk 1% of your original capital of 10,000, for example, then it is relatively safe if you know what you're doing. So that concludes this video on CFDs. I hope you find it useful and send me an email if you got questions. This is Adam Koo, and I'll see you in the next lesson.